Why does the United States always run the world's largest trade deficit? Today, we're diving deep to uncover the real causes, from savings and investments to exchange rates and the dollar's global role. Imagine a chart showing the world's current account balances over 35 years. Surpluses sit above, deficits hang below. You'll see the US flying the deficit flag solo, importing far more than it exports. Even presidents have tried to reverse it. But is a trade deficit truly bad? And what keeps it going? A trade deficit simply means imports exceed exports. At first glance, you might blame cheap foreign labor or an uncompetitive manufacturing sector. But economists point to a different culprit: low national savings relative to investment. In economics, savings equals income minus consumption, money you park in the bank or financial assets. Investment means spending on factories, equipment, and productive capacity. In a closed economy, savings must equal investment. When they don't, trade opens to fill the gap. Here's a key identity: trade balance equals savings minus investment. If a country doesn't save enough, it must import capital, leading to a trade deficit. But there's a hidden player: the exchange rate. Picture the dollar depreciating by 50% overnight. Suddenly, everything US exports costs half as much abroad, imports halve in price domestically, trade balances shift dramatically. Exchange rates naturally correct imbalances unless something interferes. So why hasn't the dollar weakened enough to fix the US trade deficit over nearly 50 years? One theory is market intervention, yet the US rarely props up its currency. Often it lets it float freely. The real driver lies in capital flows. A country's balance of payments comprises three accounts: the current account, trade in goods and services; the capital account, asset transfers; and the financial account, stocks, bonds, foreign direct investment. Most nations focus on the current account, but for the US, the financial and capital accounts dominate. Foreign investors purchase US assets, treasuries, corporate bonds, equities, driving up demand for dollars and sustaining its value. This persistent investment inflow keeps the dollar strong and imports high, locking in a trade deficit. Why do global actors keep buying dollars? Because the US dollar is the world's reserve currency. Exporters and central banks accumulate dollars and then reinvest them back into US markets. That perpetual cycle props up the dollar and underpins America's external deficits. Historically, a turning point came in the early 1970s when the US left the gold-backed Bretton Woods system. Oil began trading exclusively in dollars, establishing the Petrodollar system. This arrangement expanded global demand for dollars, enabling the US to issue more debt and maintain deficits. In the 1960s, economist Robert Triffin warned that issuing the global reserve currency inevitably leads to deficits, a dilemma now bearing his name. The US prints or issues debt to supply global liquidity and in return runs persistent trade deficits. Is a trade deficit good or bad? It depends. Australia's decades-long deficit reflects growth and strong investment. By contrast, unchecked borrowing and consumption, like some Eurozone countries before the 2010 crisis, can trigger financial turmoil. Context is everything. For half a century, America's trade deficit has endured because the dollar's special role attracts capital, keeping its value high and imports abundant. It's not merely about consumer habits or fiscal policy. It's a structural feature of the international monetary system. When politicians decry trade deficits as proof of economic weakness, remember the larger picture: the interplay of savings, investments, exchange rates, and the reserve currency privilege. These forces shape global trade patterns and chronic US deficits. Today we've peeled back the layers: low national savings, exchange rate mechanics, massive financial inflows, and the dollar's role on the world stage. Each piece contributes to America's unending trade deficit. In the end, a trade deficit is a symptom, not a sin. Whether it's a sign of healthy investment and consumption or a warning of imbalance depends on the circumstances behind it. If this deep dive helped you see through the headlines, subscribe for more economics and global finance explanations. Hit the like button if you learned something new, and let me know in the comments what topics you'd like to explore next. Thanks for watching. See you in the next video.